I wouldn't own as much gold as I own if I thought it was going to go from $2,700 to $3,000. I own it because several times in my life, it's gone up fivefold or sixfold or sevenfold. I own it because the net on-balance sheet and off-balance sheet obligations of the U.S. government exceed $120 trillion. And those obligations, both on and off balance sheet, annually exceed the gross income of the federal government before expenditure. That's why I own gold. I don't own it because I hope it's going to go to 3,000. I own it because I'm afraid it's going to go to 9,000 or 10,000.
Gold's success in 2024 is built on a rally that began in 2022. Many investors, including those who have looked to gold IRAs for diversification into a physical asset for retirement, are wondering what will happen next, especially because the price of gold dipped after the recent presidential election. Gold is often regarded as a refuge in times of crisis. When markets crash, investors turn to gold to protect their money. For example, during the 2008 crisis, the price of gold soared. In this video, RickRule of Rule Investment Media reflects the importance of holding gold. Rick stresses owning at least 5% of one's net worth in physical gold as a safeguard against economic uncertainty. Rick emphasizes that gold often leads bull markets, but silver can surpass it in speed and scale during rallies. Concurrently, he notes that even small investments in gold historically protected portfolios from inflation and dollar depreciation. Gold and silver stood out as key performers, achieving record highs on MCX, while crude oil stabilized within a range as OPEC and non-OPEC tussles continued. Regarding gold, Rick dismisses short-term price targets like $3,000, emphasizing that he owns gold for its potential to rise fivefold or more during economic distress. History suggests that the benefit of holding gold to protect against currency weakness over the long term can outweigh any drag from currency strength. In fact, the US dollar is as strong today as it was at the turn of the century, while gold has appreciated 813% in the same period. Central banks are projected to maintain their gold purchases, sustaining bullish momentum in gold prices, while the strengthening dollar could limit gains in other commodities and industrial metals. Now we present the clips of RickRule's insights from his recent interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates.
And as you know, Duncan, I'm an unconstrained gold bug. I would suggest that people have at least 5% of their net worth in physical gold. And I would suggest that they hope it goes down in price. The set of circumstances that causes your gold to go up rapidly in price, which I think we're likely to see, are invariably fairly unpleasant. But certainly if silver is cheap, gold is cheap too. Gold generally moves before silver does, although silver, when it moves, generally moves further and faster. If the question goes to holding physical commodities as opposed to holding equities around physical commodities, the most convenient to hold and store are gold, silver, and platinum and palladium. Many, many, many investors are. It seems that when investors get bitten by the gold bug, they often go whole hog. In my life, when gold has moved, the moves have been dramatic. And if you think of it as I do, as insurance, a fairly small premium goes a long way. If, as an example, you had had gold at the beginning of the decade of the 70s, understanding the type of inflation that we would experience in the 1970s, when the gold price moved 30-fold, had you had 10% of your portfolio in gold, you would have enjoyed a triple over that decade on your total portfolio. If you had gone through a much more modest bull market, like the period 2000 to 2010, where the gold price went from $250 an ounce to $1,750 or $1,800, which is to say a sevenfold increase. A fairly small proportion of your net worth in gold would shield most of the rest of your portfolio from the harmful impacts of the deterioration in the purchasing power of the US dollar. Many, many, many people overinsure. Many, many, many people have too much of their assets in physical precious metals or, more riskily, in penny stocks associated with gold and silver. I wouldn't own as much gold as I own if I thought it was going to go from $2,700 to $3,000. I own it because several times in my life, it's gone up fivefold or sixfold or sevenfold. I own it because the net on-balance sheet and off-balance sheet obligations of the U.S. government exceed $120 trillion. and those obligations, both on and off balance sheet, annually exceed the gross income of the federal government before expenditure. That's why I own gold. I don't own it because I hope it's going to go to 3,000. I own it because I'm afraid it's going to go to 9,000 or 10,000.
While reflecting on markets, RickRule emphasizes the significant disparity between future trading volumes and the actual physical metal available for delivery. As central banks continue to warehouse physical gold, he warns of potential disruptions in the availability of good delivery metal needed to settle obligations. In a note published Wednesday, UBS strategists highlighted several catalysts expected to continue driving upside in gold prices next year. Among those is the accumulation of gold in central banks, which UBS believes will continue in 2025 as part of their diversification strategies. The International Monetary Fund data shows that global central banks' net gold purchases in October recorded this year's highest monthly level. UBS has revised its forecast for official sector gold purchases to 982 metric tons for 2024, up from a previous estimate of 900 metric tons. However, Rick advises maintaining some gold and silver within the system for liquidity while acknowledging the advantages of personal possession for other purposes. Let's get back to the interview.
But I'd like to discuss it. The gold and silver price is nominally, at least, as is suggested, set by the LBMA and the COMEX. It's important to note that most days, the futures market in precious metals trades over 100 times the amount of gold and silver available for physical delivery. To the extent that increasing amounts of physical gold in particular are removed from access to COMEX, I'm not saying for sure that's going to occur, but I think it's a very interesting circumstance. And it's interesting to note, too, that when that happens, many people who suggest the inevitability of, the inability of that to become a problem, forget the fact that in order to settle COMEX or LBMA obligations, the physical gold and silver has to be good delivery, which is to say all the scrap gold and silver, all the gold and silver outside the system, all the gold and silver held by the Indian peasantry, can't automatically be used to fulfill those obligations. It needs to be often re-refined, re-assayed, and entered into good delivery. So the circumstance where the continued warehousing of gold by foreign central banks begins to disrupt the availability for good delivery in a market where 100 times the amount held for good delivery trades every day becomes an increasing challenge. I would tell people, too, that one of the reasons why you should hold your physical gold and silver in system available for good delivery is that very often if you're engaged in midnight gardening, which is to say if you hold the gold and silver yourself in your backyard and you want to take advantage of price movements, short-term price movements, you need to reintroduce that gold or silver into the system. I'm not suggesting that there aren't other reasons to have physical gold and silver in your possession as opposed to in system. But if you are using it as investment liquidity, it's important that you have some in system where it actually is liquidity. I think a lot of your listeners have attended our boot camps. But for the benefit of those who haven't, the boot camps are 8-hour-long live deep dives that are broadcast online. We've done uranium, we've done silver, we've done development, we've done a lot of things. It's important to note at the beginning that these are not entertainment products. If you're the kind of person who used to buy the newspaper for the funnies, when I say deep dive, we pack a lot of information in 8 hours. Some of the words that are used, you are probably going to have to Google or Wiki. And when I say 8 hours, that's the down payment. We're going to give you more information in 8 hours than you can absorb in 8 hours. And likely, a month out, you're going to have to refresh your memory and listen to it for another 8 hours. So if you aren't prepared to donate 24 hours of your life to learning a lot about gold,
although no one can really know what will happen, and each investor needs to do what's best for themselves, gold's success in 2024 after the presidential election and its projected success in 2025 seem to suggest that gold and silver's safe haven qualities are still in play. Do you believe gold's historical performance and central bank strategies will continue to bolster its appeal as a key investment in the years to come? Drop your thoughts in the comment section below. If you find this video informative, don't forget to support our channel and turn on notifications to stay informed about our latest videos. See you in the following video.